Welcome to this month's edition of our monthly 5 in 5 video series. My name is Antonio Vaiente and I'm Head of Business Development here at AZ Sestante. And once again, I'm accompanied with Mitch Ely, our investment analyst here at AZ Sestante. We're going to look at all things markets in the past month and how we see things going into the future. So Mitch, welcome. Mitch, what were the big stories driving markets in June?
So Antonio, June was another strong month for markets, with shares around the world posting solid gains despite plenty of uncertainty in the background. Now in the US, big companies led the way, particularly in names like tech, consumer discretionary and energy, as investors stayed pretty upbeat around the economy and the opportunities, particularly around artificial intelligence. We also saw other overseas markets bounce back, particularly in emerging markets Asia, whilst Australian markets also edged a little bit higher, helped by the hope of future rate cuts. Now, bond yields fell and the Aussie dollar strengthened as confidence improved, but it wasn't all smooth sailing. And there's still simmering tensions in the Middle East that could flare up, and we're watching signs that the US central bank may be giving into political pressure, which could hurt its credibility longer term. So whilst it was a positive month for portfolios, it's a reminder that there are risks out there. Staying diversified and disciplined remains key.
So Mitch, what can investors really take away from this month's moves?
So again, markets showed a lot of confidence in June, with strong gains led by some of the riskier parts of the market. And again, think areas like emerging markets and sectors tied to growth, such as tech and consumer discretionary. Now that sort of rally is often a sign of what we call animal spirits. Now this is where investor sentiment starts to run ahead of the fundamentals. This time likely fueled by the growing expectation of rate cuts in the back end of this year. Now, whilst we're cautiously optimistic on growth assets, particularly over the medium term, given what we're seeing in inflation and stable economic data, we do think equity markets have gotten a little bit ahead of themselves, particularly in the short term. Now, prices in some parts of the market, particularly that kind of large cap US tech end of things, are looking a bit stretched again. Now, for investors, again, it's an important reminder to stay diversified, focus on the long-term plan, and not get caught up chasing returns, particularly when markets are running hot.
So with all that said and done, how are our portfolios really positioned right now?
So AVM portfolios right now, we're running a small overweight to growth assets overall, reflecting our cautious optimism on the outlook ahead. Now within shares, we prefer global equities over Australian, with a bias towards Europe. Now this is particularly where valuations and opportunities look more attractive for us. As a result, we're underweight the US stocks, given how expensive they've become. We're generally neutral on emerging markets for now. We hold a small overweight to real assets, I think things like infrastructure, which adds a layer of diversification and some inflation protection. On the defensive side of the portfolios, we're generally underweight, keeping less in cash and bonds than usual, but still holding enough high quality fixed income to provide balance if markets begin to turn. It's a carefully balanced approach, leaning into opportunities where we see value, while staying mindful of the risks ahead.
So that's great, Mitch. So how did the portfolios perform in June? Have there been any highlights?
So Antonio, all of our portfolios delivered positive results in June, benefiting from the strong rally across markets. Now, our decision to stay overweight global equities compared to Aussie shares really helped as global markets continued to climb. Now, among our managers, the higher risk technology names did well, but both GQG and Brown underperformed the broader market, being underexposed to this asset. Now, that said, we still have strong conviction in these strategies. We believe their defensive positioning will serve investors well, particularly if markets start to turn volatile from here. Now on the defensive side, bonds also performed nicely as yields fell, with global fixed income slightly ahead of Aussie for June. Now most of our managers kept pace with the market, which is positive to see and a testament to active management in these asset classes. Inversely, real assets lagged a little bit in June as investors began to rotate out of defensives into more cyclical areas in the market. Overall, it was a solid month for portfolios, with positioning working largely as intended.
So let's get our crystal ball out again. What do you see happening in the month ahead?
So as we start to move into July, there's a few key things we're keeping an eye on. The big one is interest rates, as markets are still expecting cuts later this year, but that could really change if inflation begins to pick up again, especially in the US. And we're also a little bit concerned that the US central bank seems to be under more political pressure than usual, which could hurt confidence if it looks like they're being influenced too much. Now, another key risk we're looking at is obviously President Trump. July 9th is when the sort of trade deadline starts to hit. Now, he's given other countries 90 days to reach new trade deals with the US, and if that doesn't happen, he's threatened to impose another wave of higher tariffs. Now, that could obviously weigh on global trade, unsettle markets, and add a fresh layer of uncertainty for investors. So with all of that in mind, we're keeping portfolios balanced and ready for different scenarios. We're underweight some of the more expensive parts of the market, like the big tech stocks that have run up a lot lately, and we're focusing more on areas of the market that look like better value and more resilient if things turn choppier from here. Now, importantly, we're happy with where portfolios are today, and we'll keep a close eye on things as they continue to develop.
Thanks once again for joining us for our monthly 5 in 5 video series. If you've got any questions or queries, please do not hesitate to contact us via our email at invest@azsestante.com. Until then, we look forward to seeing you next month. Bye for now.